Hey everyone, I'm very excited to have Josh on the channel here today. Josh is the CEO of Elite UK REIT Management. He's also a seasoned real estate veteran with over 2 decades of experience in the finance and fund management. Okay, so previously he was instrumental in the IPO and the subsequent growth of Lendlease REIT, where he was a CFO over there. Okay, so Josh, thanks so much for joining us.
Thanks for having me, and also thanks for making me sound quite old.
Yeah. Can you maybe tell us a little bit more about yourself and Elite UK REIT?
Yeah, sure, I'm happy to. So I've been at Elite UK REIT for about 1 year and 3 months now. Before that, I was with 9 years with Lendlease. My very recent last job, I was a CFO for Lendlease Global Commercial REIT. I was part of the IPO team, and we did our first transformational deal back in 2023 before I moved on to my current role. And I think for me, it has been a very good journey. I started my first 10 years of my career in banking, and then move on to Lendlease before coming here. So in some ways, it feels like I've gone one full circle, because when I was in the bank, I was covering REITs as well as my clients. So it's a very small industry. Many of them were my clients, are now my friends, and also people in the industry that I look up to. So I learned a lot from the people in the REIT industry as well.
Nice to hear that. Right. So the next question I have,
Yeah.
let's move to the results. The first half 2024 performance.
Yeah.
So despite a slight decrease in the revenue and net profit, your portfolio overall registered 0.6% growth in the valuation.
Yeah.
Right. Can you elaborate more on the reasons?
Sure. I mean, for us, the valuation was something that was very reassuring. Typically for REITs in Singapore, you only need to have a valuation once a year. We have ours in December to coincide with the financial year end. So this time around, we called a half-year valuation. It's a bit off cycle, but I think through it we are quite assured that the valuations has stayed solid. For the last 2 years, because of interest rates and inflation, the valuation has fallen quite a fair bit. I think maybe from crest to trough about 20%. So this is the first time, I think, where the valuation has firmed a little bit, and it's a slight 0.6% increase, as you mentioned. On, I think, revenue and distributable income, I think what sits between the two is generally your borrowing costs. So for this time around, for our results, we actually put a waterfall chart. So last year we had 145 occupied assets, and you will recall around April last year we did a lease regearing exercise. So what happened? A few things happened out there. One, we had agreed to provide sustainably sort of capex to the clients instead of giving them rent free, which I think most landlords or tenants do negotiate for that. So instead of doing rent free, we give sustainability capex to our client, which is to our tenant, which has been very well received, because these assets that we own are triple net lease to the UK government. So as they spend money on sustainability, and these are things such as changing the light bulbs to LED light bulbs, or double glazing the walls so that your heating doesn't escape the building. So all these things actually contribute to immediate cost savings once it's implemented. So for the tenant, this is something that they really do look forward to. So that happened, and we had, I think, through the lease regearing exercise, we had also had a few vacant properties given back to us. I think about 7 properties. And then as a result of the lease gearing exercise as well, we removed all lease breaks between then, which is last year, till 2028. So we got 5 years of solid government-backed income. The fourth thing that we did during that was to actually increase our rental rates. So how I think the revenue has turned out was that whilst we have lost some in terms of the vacant assets, the revenue escalation, the rental escalation actually helped to make up for that loss as well. So Like for like, last year I have 145 occupied properties, now I have 143 occupied properties, slightly lower, but the revenue has just dropped by 0.1 million. And for the I guess the key difference between your revenue and distributable income generally is your cost of borrowings. So I think this start of the year, as you may be aware or the market might be aware, we did a very strategic fundraising. Through that, we raised altogether 38 million together with the dilapidation settlements that we received from the outgoing tenant, as well as divestments. We used all this money to reduce our leverage. So we have done quite a fair bit in the last 1 year. Currently, our leverage is about 41%, much lower than when I picked on didn't take on this job as well. So I think that together with the firming of the valuation has been very positive for us.
Looks very positive on the whole.
Thank you.
There's so many developments going on.
Yeah, I mean it's been all hard work for not just me but the entire team, and I think it has been a very a very interesting and very educational journey for ourselves as well.
Nice. Okay. So moving on to the next question, right? Speaking of rental reversion, so I saw one incredible development which was the 30% rental reversion for Dallas Court at Salford.
Yeah.
So this kind of unheard of from all the REITs I've seen so far.
Yeah.
So can you maybe share more details on this?
I wish that was for the entire portfolio, but it's just one, and we have 150 properties. Our properties are all diversified around the UK, right? We actually do have, so for that particular property, it was not leased to the Department of Work and Pensions, which is our largest tenant. It's actually leased to the Home Office. So the Home Office is, I guess, the part of the UK government that that takes care of the police, the border forces, and so on and so forth. So they renewed that, and I think one reason why that has the rental revision has been so much is because I think generally the in situ passing rent that we have on our assets tend to be on the lower side. And if you sort of look at the last few years, inflation has been trending up. So when we had the opportunity to release this particular property, what you find that is in general is the rest of the market has caught up. I mean that's what real estate sometimes is, right? It's about timing and cycles. So for that, I mean having that increase by 30%, I think it's because I think the entire market has caught up. And we do hope that when we go into the 2020 lease, renegotiation with the Department of Work and Pensions, we will also benefit from some of these uplifting of rentals in the various markets. On average, we lease our portfolio to the UK government in general at about 11 to 12 pounds per square foot per annum. So that is very much under-rented. If the tenant wanted to move to new buildings around the areas, we estimate they probably pay about 4 times more, like 40 to 50 pounds per square foot, because not only have costs gone up, but also I think financing costs has gone up. So that has also constricted somewhat the ability of people to be able to deliver new buildings cheaply. So I think that plays to our favour as well. At least we're not worried that our assets are over-rented when it comes to renewal. The tenant is actually at risk of leaving the property because we're charging too much.
Sounds good. Right. So talking about following up on the question, right? Let's talk about occupancy rates. So I recall that the occupancy rate for the portfolio is at around 92% for the first half of 2024.
Yeah.
So what is your view, your take on this, whether it can increase going forward?
I think it will increase. I think one thing we've said, not in our presentation slides but in our press release, is that we do have some positive offers for some of the assets that are vacant. We will be expecting to sell them and hopefully be able to report that by next time we have business update in September. So I think that's something we're progressing on. So far our strategy has been to collect the dilapidation settlements. Just to explain a little bit what that is, I haven't really touched about that. So I think in Singapore's context, when a tenant leaves a office building, for example, or retail building, or retail shop, they actually have an obligation to reinstate the property back to what it looked like before when they took it over. So you need to paint over the walls, remove all your fittings and all, and that's quite costly, right? In UK as well as in Europe, it's quite common that the tenant will just leave some money behind. You can negotiate what that amount is. It's usually pegged to how much space you have. It's a lot more if it's a big building, and smaller, it's a smaller amount if it's a smaller building. So for us, getting a decent sum of dilapidation settlement amount is very important, because some of these actually can turn out to be rather substantial, right? So once you do that, then you could actually sell the property. Now, if you sort of sell the property in advance and you're going through this negotiation with the outgoing tenant, that might actually jeopardize the amount that you may receive. So for us, last year, I think we managed to clear a batch. Now, with this second batch of dilapidation settlements, which we have recently received, that will be used to pay down our debt to get to a gearing that's less than 40%, which is I think where we want to get to. So coming back to your question, so whilst we were sort of managing the dilapidation settlements, and we finally concluded and received the money in our pockets now, we actually had a few positive bids for our assets, and we couldn't do anything about it. We just need to keep them warm. So now that the dilapidation settlements are now out of the way, we will progress on some of these offers to see, to get the best value for our unit holders. So fortunately, I think if your next question might be, are they above valuation? I think we alluded to that it is in our press release without saying too much, because these bids or these offers are, I think, are still being progressed. So they've given us their offers. Now we need to accept and go through the legal documentation. Okay. Again, we're also trying to progress that quite soon, so that we can bring our gearing down sooner to sub 40%.
Okay, sure. So talking about when you have the previous tenant going out, and before you get a new tenant, there's this settlement that you receive. So these assets are like vacant during that period of time.
Correct.
So talking about the vacancy assets, right? I saw that you also have 5 divestments in the past year, right? With 12% premium or overvaluations. So can I know what are your future plans for these vacancy assets?
Yeah. So I think we've got 3 offers, so we'll sell them. The rest, we may sell a few others. Others actually will tie in, I think, with some of our more strategic medium to long-term plan. Back in April, we announced to the market that we're going to expand on our investment strategy to include living sector assets, and this is predominantly student accommodation and built-to-rent residential. So to be sure, we're actually not giving up on the existing portfolio that we have, which is social infrastructure and government workspaces. That's a very good core cash flows, very resilient, very defensive. But we do want to have some options in case, when we renew the leases, some assets do come back to us vacant. At least we have other ways to deal with it. And the assets are quite complementary to each other in the locations that they are for student accommodation and built-to-rent residential. For example, the job centres that we own that makes up the majority of the asset base, that tends to be very well located in town centres and cities, regional cities, and they tend to be closer to bus stations and other sort of amenities. So if they do become vacant, we do have more options now that we have expanded our mandate to include student accommodation and built-to-rent residential.
Sounds cool. Okay, so now let's hop over to the capital management side. So I saw that you have really reduced your net gearing from I think 47% to 41%, right?
Yeah.
And you have completed refinancing for all the debt until 2026.
2027.
2027.
Yeah.
Okay. So now that you also have obtained this kind of sustainability-linked facilities, can you explain more like what are you going to do on the capital management side?
So I think, as I mentioned earlier on, when we did the the fundraising at the start of the year, that was rather strategic for a few reasons. One, I think we had Sunway, our sponsor, step up to support the deal, and they became the second largest unit holder as well. Of course, we have our other sponsor, Elite, that's also helping us on this transaction. And they sort of backstop the deal together with our partners, REIT in the US, which is our largest unit holder. So this whole deal was effectively underwritten mostly by our major shareholders as well as our sponsors. Using that, we then sort of went to our sponsors' banks, right? And these are banks in UK and Asia. Before, I had 3 lenders for quite a fair bit of debt load. We're looking at about 200 million pounds back then. So that is a lot bigger if you consider that that's roughly about 340 million dollars, right? So now we have a much more sustainable sort of a platform where we have 5 lenders instead of 3. Everyone's quite diversified. So that's something that we like. The terms that we have managed to get from the lenders are also a bit more aligned to our market and a lot better than what we had before. So I think this this was rather strategic in that sense. And of course, we talk about sustainability linked financing. So I think we may be the first one to have 100% of our debt and sustainability financing among the REITs. I think that's something that we're incredibly proud of. But not only does it align our sustainability ambitions, right, which is really to increase the overall performance rating of the assets, it also aligns with the bank's expectations or wish that we will do a lot better in the area. And I think core to that is really partnering with our tenant, the DWP and others in greening these assets. So we expect that when we go into our lease negotiation for 2028, the sustainability collaboration program that we have with our tenants, which we know has been very well received, we expect that to have a sequel to it as well. So I think that's the expectation, and it kind of pays for itself as well, because as the asset is green, right, the tenant wants to stay longer because they enjoy the benefits of the capex. They sign longer leases, and that will also improve the valuation of the assets. So in that sense, it's a virtuous cycle that we're getting into. So a sustainability linked financing is a bit different from a green financing in 2 ways. One, of course, you have a KPI to hit, but if you hit the KPI, there are benefits to you. There is an incentive. So our interest margin, for example, will step down. It doesn't step up; it just steps down if we hit our KPIs. Yeah. And the KPIs are set. And there's some aspirations to it. It needs to be something that's achievable as well. Because at the end of the day, I think when the banks supported us on this financing, on this sustainability linked financing, they also want us to succeed. So I think the thresholds that are being set are ambitious enough, but it's also achievable from our perspective.
That's good to hear.
Yeah.
So talking about the balance sheet. Now that you are more stable, so now let's move on to distribution.
Yes.
Right. So from what I see, the distribution yield for Elite UK REIT is pretty high, given that the share price has gone down a bit.
Yeah.
So, but in the recent results, the first half DPU was a slight decrease from last year. So can I know your plans on how to potentially increase the DPU going forward, and will you have other plans to conduct any rights offerings or preferential offerings?
Yeah. I think when we did the fundraising at the start of the year, it was a bit unheard of not commonly done, right? And I understood that that's going to be a silver bullet that you can only fire once. You can't do it over again because then you lose trust to the market. But we had to do it, and we took that fundraising and make it go a long way, right? Not just gearing, but also extending the financing and putting ourselves in a very good position. There are other REITs in the market. Some of them couldn't do much, and then their gearing goes above 50%. But for us, For example, vis-a-vis the US REITs, there is no 9.9% cap for sponsors or any unit holders that they have to keep to. So that allows our sponsors to really support this transaction. So I think that was from my perspective something that is painful. One time, can't do it again. Don't want to do it again. Type of thing. And having the valuation now stabilized, I think that gives us a lot of comfort that we probably won't go into that zone again, right? As to how we can increase the DPU, one would be really to extend the leases, right? I think not only will we get, we not only do we want to push out the lease expiry and even to different profiles, we of course want to get a higher rental rate. And like I said just now, if all my assets are all my 149 assets are all at 30% rental reversion, that's there's going to be a big score for us to achieve, right? But the other things that we're doing, some small things, with the debt, for example, we actually receive our rentals 3 months in advance from the UK government. So up till now, I think what we do with this money is just to park them inside bank accounts. The banks doesn't even pay us much in terms of fixed deposit or rates or anything like that. That was just the structure that I inherited. With this new loan structure, we're getting a good interest rates from an Islamic banking account out of it. We also pool our cash together so we get a higher interest rates. But the other thing that we've sort of really changed things is that we've incorporated revolving credit facilities into our structure of our loan. So now what it means is that when I collect my rental 3 months in advance, I don't need the money because distribution is maybe 3 months to 6 months down the road. I take this cash that I receive in advance from the UK government, pay down my debt so that my finance cost is optimized. And when I do need the money, I can draw them back up using the revolving credit facility. So I think that's something small little things, but everything helps, right? Then of course now that we refinance our debt, we are probably looking next thing at hedging our interest rates. I think that's also an opportunity. Interest rates in the UK is still inverted, meaning to say that your interest rates that is shorter tenor is actually higher than your interest rate of a longer tenor. So if I don't hedge and just leave it floating, your 3 months SONIA, which is your base rate, is roughly about 4.95%. If I hedge 3 years for 3 years, ironically the rate is actually right now about 3.7, 3.8%. So meaning to say that just looking at hedging, I would actually get some interest cost savings. So I think previously we guided the market just be a bit conservative a few months ago. We weren't quite sure when the Bank of England will cut rates. We weren't quite sure where the market was. So I think we've guided the equity analysts, the investment community that when we refinance, maybe we'll look at an increased cost of debt. But right now, I think that risk is probably much lower. In fact, we might even get to a rate that's lower than what we had achieved before. So I think all these things are looking positive. And finance expenses, I think, has been the sort of the element that has reduced distributor income for many REITs, not just us. So I think being able to manage that in an effective way is going to be important.
Cool. So the balance sheet and the distribution yield and everything, the financing portion, I think they're doing a pretty good job.
Thank you.
Because of your background as well, because
yeah.
you're from the finance sector. Yeah, but now let's hop over to the expansion plans.
Yeah.
So Elite UK REIT is diversifying into the student housing and the build-to-rent industrial. So can I know what specific opportunities do you see in this area and how do you plan to capitalize on the demand going forward?
Yeah, so I think the other thing perhaps that you will talk about later is the UK government change. So recently the UK government had a change in the Labour Party, became the ruling government. And one thing is quite clear, the UK is undersupplied in terms of residential units. Some of our colleagues are also facing some the increased cost and they have to move further out of London. So these are things that affect your day-to-day, cost of living or standard of living, right? So I think there is right now pretty much a very strong tailwind, both from the policy perspective as well as from the market demand for built-to-rent residential. Of course, I think the built-to-rent residential works if you are well located within cities and towns, which our assets are. So we are now sort of moving to 2020, looking at some of the assets that we potentially could take back when we renew the leases and reposition them into built-to-rent residential or student accommodation. And then right now, I think the most immediate opportunities is just looking at vacant assets, because I think that is really on the table, right? So we could sell some, and some we might convert them and try to deliver some of these schemes. Unfortunately, I think it's a lot easier to talk about wanting a change of mandate and expanding the portfolio. But I think a lot of work is being done in the background to make sure that we be it attempt a AEI or acquire. We need to do the right thing and acquire well, or do a good AEI for unit holders, and not just do it for the sake of doing. That's why it might take a little bit of time, but we're working to get the best possible deal for all investors.
Okay, nice. So talking about the market outlook, you said that there's a change in the UK government, right? And recently the Bank of England has cut interest rates from 5.25% to 5%. So how do you anticipate that the new government's policies will affect Elite UK REIT?
Yeah. So I think it's probably in the first 100 days, still not even the first 100 days of the UK government at this point in time. But I think they well telegraphed a few things to the market. I think one, they've said that I think they may have to raise taxes. For us, UK REIT, for us, Elite UK REIT, we're actually a UK REIT, so we pay the same amount of taxes as any UK REIT that's listed in the UK. So that includes, for example, no corporate income tax. So some of these taxes might be raised. It will not affect us directly, but maybe indirectly, right? Because VAT and all that. Then the other thing that telegraphed to the market is that they intend to build more homes, right? So under the last Conservative government, I think they built less than 1 million homes over 14 years. So probably like 0.9 million, I think was the number I saw. Now over the next 5 years, the UK, the Labour Party has committed to build 1.5 million homes. So that's about 300,000 homes per year. So what they have done at this point is to basically agree that the planning system needs to change, and to that end they actually have launched a consultation paper, and we are about to respond to it as a UK real estate player landlord, on what the consultation, what the planning system rather needs to change, and that can actually accelerate some of this home building by us or other of our peers.
Sounds good. So last question from me. Right, looking ahead, what is the challenges and the opportunities for you, Elite UK REIT? Yeah.
I think my greatest challenge right now, if you look at the stuff that we've done, we have managed our vacant properties. I don't think it's a challenge to extend the lease, and it's a matter of when, not if. Given that the UK government, the Labour Party is actually very focused on bringing people back to work, these job centres are very much needed, more needed than ever. So I think that's quite solid for us. So that's probably not a challenge. So I haven't really answered the question, but I think the other challenge that we will have is really finding the right opportunities to grow. We work very hard to get to where we are today. We also have worked very hard to earn investors' trust. So that cannot be easily squandered, in my opinion.
Okay, that's all the time we have today. A huge thank you for
Thanks for having me.
For sharing all these valuable insights with us. I greatly appreciate you being here today.
Thank you.
Yeah. So once again, thank you everyone for watching this video. Thank you.